Welcome to The Deep Dive, your go-to source for extracting the most important nuggets from the latest financial insights.
Glad to be here.
Today, we're plunging into the CME Group's second quarter 2025 earnings call.
And what a call it was.
Yeah, this wasn't just, a good quarter for CME Group. It was a truly standout period, really showcasing robust growth and some significant strategic moves.
Absolutely. In what continues to be a remarkably dynamic global market, I might add.
Definitely. The numbers coming out of Q2 2025 are, exceptionally strong.
They really are. It reflects a period of truly exceptional performance driven by this persistent demand for their risk management products.
Okay, so let's unpack these headline numbers right away because they do paint a pretty impressive picture.
Let's do it.
For the first time in CME Group's history, their average daily volume, the ADV, it soared past 30 million contracts.
30.2 million to be exact.
Which is just a remarkable 16% jump compared to Q2 2024.
Yeah, and that included some all-time monthly records in there as well. Huge volumes.
And that surging volume, obviously, directly propelled their financial results. Total revenue for the quarter reached $1.7 billion.
That's a solid 10% increase year over year.
What's particularly notable, I thought, was their core clearing and transaction fees. They hit a historical high.
Right, $1.4 billion, up 11% year over year. I mean, this is the heart of their business, just showing immense strength.
And it wasn't just trading fees. Their market data revenue also hit a record.
$198 million, up 13%, also very strong.
And when you look at the bottom line, it's equally compelling. Adjusted operating income, a record $1.2 billion.
Which is up 14% year over year. And that pushed their adjusted operating margin to a very healthy 71%.
Yeah, up from about 69.1% in the prior year. That signals some impressive operational efficiency gains.
The efficiency gains are certainly clear, yeah. This translated straight into their strongest ever adjusted net income and diluted earnings per share.
So adjusted net income came in at $1.1 billion.
And adjusted diluted EPS at $2.96. Both metrics saw a powerful 16% increase from the prior year.
These figures, they genuinely underscore the significant growth CME Group experienced.
Right. And it's all underpinned by this broad global demand for their essential hedging and risk management services.
Okay, so with those impressive headline numbers as our backdrop, let's really explore what's been driving this performance.
Yeah, let's get into the details.
Starting with the volume dynamics and the broader macro environment. One of the most striking points was that this growth was truly broad-based.
It really was, spanning all 6 asset classes.
We saw all-time quarterly volume records in interest rates, agricultural commodities, and metals.
And financial products volume alone grew by 17%, with commodities up 15%. So strength everywhere.
What's interesting here, though, is how management characterized this. They called it a continued risk-on environment.
Yeah, which is kind of interesting, right? It implies that despite all the global uncertainties, sophisticated market participants are actively deploying capital.
Not just hedging defensively.
Exactly. They're using CME's products not just for defense, but to express directional views, manage exposure within that context.
So it suggests a more mature market engagement than simply fleeing risk.
I think so. And open interest, which is the total number of outstanding contracts, that increased by 7% from Q2 2024.
And 10% from year-end 2024.
Right. And they also noted new records in large open interest holders for both interest rates and crypto futures.
Which further solidifies that active engagement by the big players.
Definitely.
So given that, how does management see the second half of the year playing out? I know volumes are inherently hard to predict, but...
They are, but they did highlight several key drivers for what they see as sustained strong hedging activity. Ongoing geopolitical unrest was one.
Right, specifically mentioning Russia, Ukraine, and the Israel-Palestine situation.
And beyond the geopolitics, they really emphasized the unprecedented global debt levels, U.S., Europe, UK.
They explicitly called these fundamental math problems, didn't they?
They did. Problems that necessitate their services. And if you connect this to the bigger picture, it suggests CME services are becoming almost counter-cyclical.
Thriving on the very instability that challenges other sectors.
Exactly. It truly highlights their role as essential market infrastructure, especially in volatile times.
That structural demand makes perfect sense. Okay, shifting gears a bit from the macro, let's dive into their impressive international and retail expansion.
Yeah, this was a major highlight of the call for sure.
CME Group hit its highest ever quarterly volume from its international business, averaging 9.2 million contracts per day.
Which is up 18% from the prior year. Huge growth.
And this was led by record volume from EMA, right? Up 15%.
Just 6.7 million ADV, yeah. And APAC surged 30% to 2.2 million ADV, just massive growth overseas.
And this international growth was truly broad, you said, spanning asset classes and customer segments.
It really was. It reflects CME's deep integration into global markets. They saw specific growth in key regions like France, the UK, Switzerland, the UAE, Netherlands, Singapore, India, China.
Wow, really widespread.
It's a testament to their global footprint and their ability to capture demand from really diverse geographies.
Okay, but one of the standout stories from this call, I thought, was the sheer explosion in retail traders.
Oh, absolutely. The call highlighted a significant influx of over 90,000 new retail traders in Q2 alone.
That's a staggering 56% increase year over year.
And it marks the 5th consecutive quarter of double-digit client acquisition growth in this segment.
So this isn't just a flash in the pan. It seems like a consistent, even accelerating trend.
Definitely feels that way. And this rapid growth in retail participation, it directly correlates with the success of their micro products.
Wow, the micros, yeah.
They reported a record 4.1 million micro contracts in Q2. The micro E-mini NASDAQ Q100 futures contributed a big chunk of that, 1.7 million.
And beyond equities, are retail traders using micros elsewhere?
Oh yeah, they're expanding into other asset classes, like gold, which saw a 37% increase in retail participation, micro Bitcoin up 94%, and micro Ether up an impressive 212%.
That's huge growth. It's not just about more individual trades then, is it?
No, I think it points to a significant democratization of complex financial instruments. CME is essentially bringing institutional-grade tools to a much broader audience.
And to further solidify their position in this, well, booming segment, CME Group announced that NASDAQ Q license extension.
Right, a 10-year exclusive license extension for NASDAQ Q 100 and other NASDAQ Q indexes, now running until 2039.
Which ensures continued product offerings, obviously, but also, crucially, enhances capital efficiencies for their clients.
Exactly. In simpler terms, it helps their clients optimize how much collateral they need to post, which frees up capital for other investments. That's a big win for any trader, especially retail.
What I found truly fascinating here, though, was CME's approach to these new retail traders.
You mean the education focus?
Yeah, they aren't just chasing initial volume, are they? They're investing heavily in educating them.
Absolutely. Management discussed extensive efforts like providing simulation environments, leveraging technology, hosting over 100 client events just in Q2.
Over 100 events.
Yeah, and working with 85 external trainers who speak 13 different languages.
13 languages. That's quite the effort.
It is. The ultimate goal seems to be ensuring longevity and sustained participation. They want to foster a mature and, sticky client base rather than just grabbing short-term engagement.
That long-term view on client education really speaks to their disciplined approach to business.
Agreed.
Which brings us neatly to how they're managing their balance sheet and expenses. There was a very positive update on expenses that caught my eye.
Right, the guidance refinement. Total adjusted operating expenses for the year are now expected to be $1.635 billion.
Which is $15 million below their prior guidance. Represents only a modest 3% growth from last year, despite the record volumes.
Yeah, that's pretty strong cost control. And this expense reduction is primarily attributed to two main areas.
Okay.
First, optimization of spending on the Google migration. Seems they're finding ways to minimize incremental spend as applications move over.
Makes sense. And the second?
Lower professional services and consulting costs across the firm. So it indicates a very disciplined approach to managing their cost structure, even while growing rapidly.
Demonstrates a real commitment to profitability alongside expansion.
Exactly.
So when it comes to capital deployment, how are they thinking about that?
Their strategy remains pretty consistent. They have an opportunistic share buyback program.
Which complements their variable dividend structure.
Right. The idea is to use buybacks if they see a disconnect between trading activity and overall performance, aiming to return value to shareholders that way too.
And what about M&A? Inorganic growth.
Well, they're always open to M&A opportunities, especially given their robust capital structure, but they remain, in their words, quite choosy.
Choosy, why?
Mostly due to complexities, particularly in international markets. They also emphasize that they pursue growth through joint ventures and commercial agreements, too.
Like that big NASDAQ extension we just discussed.
Exactly. That's a prime example. Just for context, in Q2, their capital expenditures were only $19 million.
Pretty lean.
Yeah, and they held a healthy cash balance of $2.2 billion, and they paid out $455 million in dividends in Q2.
Which totals about $3 billion in the first half of the year. That really underscores their commitment to shareholder returns.
No doubt about it.
Okay, so beyond the core business and the financials, CME is clearly innovating for the future. Let's look at some key strategic initiatives.
Right, from how they're adapting to geopolitical shifts to pushing the boundaries of digital finance.
First, the impact of global tariffs and those geopolitical tensions on their commodities business. That was a key discussion point.
It was. These factors are leading to supply chain realignments, which creates what are known as basis differentials.
Basically, a gap between the spot price of a commodity and its futures price.
Exactly.
Yeah.
And this phenomenon directly drives demand for their risk management products, particularly in options and exchange of physicals or EFPs.
Explain EFPs quickly.
Sure. EFPs are transactions where a futures position is exchanged for an equivalent cash or physical position. It lets clients manage physical delivery risks more efficiently without going through the open market.
Got it. So more basis risk means more need for these tools.
Precisely. And it's led to record activity in their commodities complex, with increased global participation, especially from APAC and EMEA.
It highlights how market inefficiencies, while challenging for some, actually create opportunities for exchanges like CME to provide essential hedging solutions.
Well put.
Now, one particularly intriguing initiative is their work with stablecoins and tokenization.
Yeah, this is pretty forward-looking stuff. They detailed a partnership with Google Cloud Universal Ledger,
aiming to enable 2047 movement of value, starting with tokenizing cash and non-cash assets in the clearing space.
Right. They're currently in the second phase of testing with settlement banks, and they're aiming for a solution sometime in 2026.
And the driver is increased efficiencies for clients.
That's the laser focus. This initiative could significantly enhance their ecosystem's capital efficiency, which is, a core value proposition for CME.
Another important operational detail they discussed was the new cash collateral requirement.
Ah, yes, the soft minimum of 30% cash collateral introduced on April 1st.
How did that play out?
Well, total collateral posted increased quite a bit to $316 billion from $290 billion in Q1. Cash specifically was at $133 billion.
Which is 48% of the required amount, so well above that 30% floor.
Exactly. They said this increase was partly due to April's market volatility. For July, the average cash is holding steady around $132 billion, non-cash $153 billion, total $321 billion.
So what this means for investors, essentially, is that this shift enhances the clearinghouse's stability.
All right. It reduces counterparty risk and makes CME's platform even more robust, especially in volatile markets. It's a positive structural change.
Management also weighed in on the long-term outlook for 247 trading. What was the take there?
They believe it will eventually happen globally, but the timing is, very uncertain.
How uncertain?
Anywhere from 2 to 20 years was the range mentioned.
Wow, that's broad. What are the hurdles?
Significant costs for firms to staff operations around the clock is a big one, and potential regulatory pushback from central banks on certain asset classes.
Like interest rates, FX, energy.
Exactly. Crypto, on the other hand, is already largely 247, so that might show where the future is heading eventually.
They also highlighted a successful launch in April, didn't they? FX Spot Plus.
They did, combining spot and futures FX markets. It reached $2.7 billion in single-day volume already.
And attracted new participants.
Nearly 50 active entities, including dozens of new banks to FX futures, which is significant. And they say it's already improved market quality in certain spot currency pairs.
So, tangible positive impact from that innovation already.
Seems so.
Another area of strong performance was their cash treasury trading business, BrokerTec.
Yeah, BrokerTec had an exceptional Q2, average daily notional volume of $949 billion, up 24%.
Huge numbers. April saw a high of $151 billion ADV, and they're launching something new there soon.
Right. A second matching engine, BrokerTec Chicago, scheduled to launch on September 15th.
And this isn't just about technical redundancy.
No, it's a strategic move. They're aiming to attract new liquidity pools and clients in a crucial market, essentially expanding their addressable market for treasuries.
And they also noted strong performance in repo and RV curve trading on BrokerTec too.
Yes, records there as well.
Yeah.
Repo hit $362.9 billion ADV and RV curve $2.7 billion AEV. Just strength across that whole complex.
Okay, one last regulatory point. Management seemed positive about potential SLR relief.
They did. The supplemental leverage ratio, or SLR, is a key bank capital requirement limiting bank leverage.
So loosening it up could free up bank balance sheets.
That's the idea. It could provide flexibility for bank clients, potentially freeing up capital that could then be deployed into risk management activities like trading on CME.
So management views potential SLR relief as a net positive for CME's business.
Correct. Potentially driving increased activity if it happens.
Okay, so bringing it all together, what does this all mean for you, the listener, as an investor?
Well, I think CME Group's record-breaking quarter isn't just about impressive market activity. It really underscores the increasing necessity of sophisticated risk management tools.
Especially in this uncertain global landscape we keep talking about.
Exactly. This demand seems likely to persist given the ongoing macro dynamics, positioning CME as truly essential market infrastructure.
It also highlights CME's strategic positioning, doesn't it?
Exceptionally well positioned, I'd say. Through their diverse product offerings across all asset classes, their aggressive international and retail expansion.
And that clear commitment to technological innovation like tokenization and the new trading platforms like FXBot Plus.
Right. It indicates a forward-looking company that's prepared for evolving market structures and ready to capture new opportunities as they arise.
And the financial discipline we saw, particularly in that refined expense guidance and the strong margins.
Those are key signals of operational efficiency. It supports consistent earnings growth, suggesting their financial performance isn't just strong, but potentially sustainable over the long term.
Exactly. It feels like CME isn't merely reacting to current market conditions.
No, they seem to be actively shaping future trading environments. Their discussions around 2047 trading, stablecoins, the BrokerTec Chicago expansion.
And navigating regulatory changes like SLR.
It all shows a company with a clear long-term vision and a commitment to adapting for future market needs.
All right, we've had a solid run through the CME Group's Q2 earnings call. Really impressive stuff.
Definitely a strong quarter to analyze.
Now it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea for you to ponder.
And let me just reiterate firmly, this is purely for informational and entertainment purposes. It is not financial advice. Please consult with a qualified financial professional before making any investment decisions.
Absolutely. Okay, the pitch today is this. A long position in CME Group, ticker CME, common stock.
Coupled.
A carefully sized short position in a more traditional, perhaps less adaptable, pure play online discount brokerage platform.
Okay, interesting pairing. What's the rationale behind that? It certainly sounds bold.
The rationale, while bold, draws directly from some compelling data points in this earnings call we just discussed.
Like the retail growth.
Exactly. CME's Q2 results clearly show accelerating retail engagement. 90,000 new traders, robust growth in micros, crypto, metals.
And management's deep commitment to educating these traders and actively cross-selling suggests a potentially sticky, evolving client base with real longevity.
Plus, that 10-year NASDAQ license extension solidifies CME's competitive edge in equity index derivatives, a key area for this retail segment.
Right, and CME's focus on capital efficiencies and operating a regulated platform, that provides a compelling value proposition that maybe traditional brokers might struggle to match for these increasingly sophisticated retail traders.
So the outrageous part of this idea is the direct bet on one segment, retail, having such a measurable and divergent impact on a multifaceted exchange like CME versus a traditional broker.
Right, and the assumption that traditional brokers might not adapt quickly enough to this specific trend.
Exactly. But the plausibility comes from those clear data points in the earnings call, supporting CME's unique and arguably early mover advantage in this growing advanced retail segment.
Okay, so if someone were considering this purely theoretical idea, what should they monitor?
You'd want to keep a very close eye on CME's retail client acquisition rates, obviously, and the microproduct average daily volume.
Also, watch the average rate per contract, the RPC, especially if they break it out for the retail segment, see if that shifts.
Critically, you'd have to observe any strategic announcements or competitive initiatives from the traditional brokers. Are they attempting to engage this specific type of advanced retail trader effectively?
That divergence or lack thereof would be key to the thesis playing out.
Precisely. It's certainly a thought-provoking idea for an evolving market landscape.
It is. So just to recap our main discussion, CME Group delivered a truly record-breaking Q2.
Driven by strong global demand for risk management, impressive strategic growth in their international and retail segments.
And underpinned by incredibly disciplined financial management.
Looking ahead, the company's actively pursuing innovations like tokenization and expanding its trading platforms.
All with the goal of continuing to create efficiencies and serve evolving client needs in what remains a pretty uncertain global environment.
So here's a finer provocative thought for you to consider. Considering CME's dual focus on these deeply entrenched institutional markets and this rapidly expanding retail participation.
How might this blend of old and new finance reshape the landscape for other financial services firms? And maybe more importantly, what implications does that hold for your portfolio?
That's a great question to ponder as we wrap up. Thank you for joining us for this deep dive into CME Group's Q2 2025 earnings call.
Always a pleasure.
Make sure to continue following the deep dive for more essential earnings insights.